What's up, guys? It's Cashflow Cart, and today we are talking about loading up on a dividend stock. I remember on the channel earlier, I had made a video titled "Loading Up on This Dividend Stock," and that stock was T. Rowe Price, ticker TROW. And if you guys have been with the channel, you do know that is still my smallest position. So it was kind of one of those things where I was like, I'm going to be loading up on this stock. And I guess for my own personal risk tolerance, I never really turned it into, a medium or larger position. And guys, I think that brings up a great point. Sometimes a stock can be great on paper. It can be great in your due diligence. And as you start buying it, you start building out the position. You just realize you're not as comfortable turning that stock into as big of a position as you originally anticipated, guys. So that does happen. But today we are talking about a new stock. I'm sure you guys can guess. I've been building this one pretty aggressively for, I'd say, 45 days now-ish. Pretty much all my dividends reinvested as well as net new capital in the portfolio has gone towards this stock, guys. We are going to get into that. First, I don't know what color I should go with on the lights. I like the green, and I think it looks pretty good in the videos, but then again, it kind of messes with my eyes a little bit. I think the blue is also good. I think I just did a video with white. And I wanted to do like a, what did I just do? I wanted to do like a slow fade, but all the settings on this are like rave party type settings. So I'm not really sure if that would fly for a stock market video. Regardless, let me know, guys, if you I guess we'll go with purple today. Is this purple? Anyway, I'm still like trying to get the best lighting, the best atmosphere I can. That was a little bit of a tangent, but let's get into the video, guys. So as we said, Hershey is the stock we are going to be visiting today. I will be adding just a few shares, kind of similarly to how we've been playing this one. I've been picking it up under that $200 mark, guys. We saw Hershey have this huge sell-off in 2023. That's when I originally got into it. A lot of like sugary snack type companies were really struggling because of all the weight loss drugs, Ozempic. There was a lot of other worries. Not to mention at the same time, guys, if we remember, at the same time, the cost of cocoa prices was skyrocketing. It hit all-time highs by far and away. Now we do see cocoa prices in 2024 showing some signs of consolidation. Okay, maybe a head and shoulders. I do kind of have a bias in my head that cocoa prices are going to start to cool off. That would make sense from a technical standpoint. However, I'm obviously not a farmer. I am not an East African cocoa farmer. And if I was, I could probably give you guys, some better insights. But thinking from a logical perspective here, cocoa prices have hit, like I said, an all-time high. And now with that consolidation, it is very likely they will start to come down. The way that's going to affect Hershey is obviously it's going to increase their bottom line because cost of goods sold cocoa will be cheaper. Okay, so that may have been a quick explanation, but we visited this whole cocoa shortage and this expensive cocoa price epidemic we're in right now before. I'm not too worried about the time frame of this. I'm more worried about the opportunity, the buying opportunity it creates in Hershey as their fundamentals have remained strong. So, I'm not a big reader in terms of reading, analyst stuff. Like this guy Thomas Shields has 106 followers. I don't really know that I'm not really big into listening to finance gurus. I'm more to work on my own methodology. However, I did this title caught my eye, and I think he does a great job. I just read the summary here in terms of kind of summing up my thesis on Hershey. The title, he says, stagnant performance with strong fundamentals presents an opportunity. I mean, beautifully said. We go to the summary, guys. Hershey Company has a strong brand. There's no arguing with that. If I ask you your favorite chocolate candy, it would most likely be a Hershey product. My personal favorite is Reese's Wide Moat. We talk about this all the time, okay, guys? A wide moat is a company's ability to generate bottom line for 20 plus years into the future, okay? And the way they receive that wide moat is through consumer switching cost, customer preferences, scalability. Also, it could be another thing like with Altria, we've talked about barriers to entry. Companies can receive this wide moat rating through, a variety of different ways. But with Hershey, their wide moat comes from consumer preferences and just economies of scale. I think it's a very attractive one. And I will say this, obviously, if a company has a wide moat or not, that's kind of a yes or no thing. That's a binary thing. If you're screening, you could say screen for stocks with a wide moat rating or get rid of stocks without a wide moat rating. However, in practice, and as you kind of develop your own risk tolerance as an investor, you are going to find certain wide moats are going to be more attractive to you and you're going to be more comfortable with. Does that make sense? So a wide moat that comes from one thing may not be as attractive as a wide moat in another brand. Okay? I think Coca-Cola is a great example. That's like the strongest wide moat rating that comes from consumer preferences. A lot of people love Coke. A lot of people are addicted to Diet Coke. Me personally, I've been drinking a lot of fountain Diet Cokes lately, and that's probably not the best for the long term, but they have a wide moat. Okay? Moving on, he says recent company developments include the uses of robotics and AI. I mean, that's kind of to streamline factory processes. I think this is kind of not a great bullet point to include. Robotics and AI, guys, I think that gets thrown as a buzzword into any sort of bullish sentiment type piece. But the reality is, any factory, any company, even restaurants, really anything has been driven by robotics, AI, machine learning, it was once called, for years and years and years. And, the recent developments of everyday people like ChatGPT, the recent developments of AI and the access to the everyday person, I think has really sparked in a lot of people's heads that this is some new thing. But, the truth is companies have been using algorithms and machine learning for a long time to streamline kind of their factory processes. So I think this first part of this is kind of common sense. I like to see high volume share buybacks, and the reason why share buybacks are so exciting to dividend investors is not only the obvious, it makes you a higher percentage stakeholder in the company technically, but as a dividend investor, share buybacks also make your dividend more sustainable. And they allow that dividend to theoretically grow, at an accelerated rate as long as the company continues being profitable. The reason for that is because companies only pay their dividends on shares outstanding, okay? So as Hershey acquires shares through share buybacks, they have less shares outstanding, and therefore they can allocate, more of their free cash flow pool to each dividend investor in the company. Okay, does that make sense? Strategic advertising during major events. I got no comment on that. I guess that's good. Strong fundamentals point to a well-managed company. This is huge, guys. I mean, we've talked about some serious headwinds with this cocoa thing. I mean, this is probably going to be the dorkiest sentence I could say, but unprecedented territory in terms of cocoa, okay? Hershey has still been able to be profitable and increase, their net income year over year. That really points to a well-managed company, guys. Obviously common sense. We want to be involved. We want to be invested in well-managed companies. Okay, here, short-term headwinds, provide value to shareholders. Very exciting stuff. Fundamental Hershey stock is undervalued. I agree, undervalued. We will go over the main valuation metric I like to look at apart from charting. High ROE, ROA, ROIC, and making it a potential long-term winner. I also agree. There was one thing I looked at here, and I didn't get into all this because a lot of this looks pretty boring, but Hershey has been around for over a century, grown their brand to be well known among consumers with a wide moat against competition. We keep screaming this wide moat against competition. And I don't know if you guys were with the channel when I was covering Coca-Cola and Pepsi a lot, but we talked a ton about wide moats. And that's definitely one of the first things I look for, especially being having such a leaner portfolio with only, less than 10 positions. I've 8 positions in the portfolio right now. Obviously, I look for quality and staying power in my portfolio. I love a wide moat, okay? Not to ramble. Especially during holidays, awesome. Year to date, Hershey has remained relatively stagnant, dropping 1%. And over the last year, the stock has tumbled over 25% compared to the S&P 500's 25% gain. Okay, so we've seen this divergence between Hershey and the S&P 500, and I think it creates a really good buying opportunity. I don't want to be that guy that throws around big words, but if I did want to be that guy, I would say something like it creates kind of a value or a fair value arbitrage, okay? So these cocoa headwinds have pretty much caused so much selling pressure in Hershey while the S&P 500 has been up. And I guess once kind of these cocoa prices stabilize or even start to fall, to me, it would make sense that Hershey could return to, a much higher price, okay? So let's not spend all day on this random article. Let's get into the real stuff, guys. We talked about the net income, and this is going to be another point where I kind of demonstrate, that wide moat rating. I have Starbucks here. I think we could probably compare the net income through the years of Starbucks to something like Hershey. And while Starbucks may also have that wide moat, we talk about how Hershey's wide moat is much more attractive to me. Another random tangent. Okay, so December 2019, 1,150. Trailing 12 months, 1,846. So we see a relatively explosive uptrend especially for a company as mature as Hershey. I do want to point out we do see increases year after year. And the reason why that interests me so much, and it comes again all back to this wide moat rating, is through 2020, through 2021, that was kind of unprecedented territory, obviously, for our country. And Hershey was able to increase net income in 2020 and again in 2021, and then even more so in 2022. And if I look at these net income numbers, I see a great solid uptrend. I don't see numbers that tell a story of pandemic, lockdown, panic, okay? And you can sit here and say, okay, maybe people were, stressed or depressed because of the pandemic, so they wanted more chocolate. You could say whatever you want to say. I'm not going to sit here and tell stories because of the net income, but it is important to see, Hershey was able to continue that uptrend through kind of a tough stretch for a lot of companies. All right, guys, moving on, free cash flow per share. We see a similar story. It's $6.90 in 2019, and then December 2023, $7.58. So we do see that uptrend. It just hasn't been, as pretty. I do anticipate that this number will continue to move up, especially with how aggressively we've seen Hershey, issue share buybacks. Okay, guys, moving on. We will visit the valuation. Okay, we talk a lot about on this channel. There's a lot of different valuation metrics. I know some more like, what's the word I'm looking for? I'm completely drawing a blank. What's the type of investor that invest in companies that aren't profitable? Speculative. I know some like speculative investors might use price to sales. I think some like value investors, or I don't know, ETF investors may use PE. There's a lot of different valuation metrics. As a dividend investor, what I like to use is price to free cash flow on a forward basis, guys. For Hershey right now, that is 15.63, and I like to compare that number again to Hershey's 5-year average. Okay, I say it all the time on the channel, but the reason why I use the 5-year average rather than the sector median is because I believe it makes much more sense to compare a company, back to its own historical valuation rather than to compare it to the sector, because I think something like Hershey is going to trade at kind of a premium as compared to, a lot of other guys in the sector that are going into this median. Okay, so based off Hershey's price to free cash flow of 15.63 compared to their 5-year average of 24.23, that could represent a 35.5% undervaluation. That is attractive to me, guys. Also, dividend yield. I mean, we talked about it. Dividend yield we can use as a valuation metric. And essentially all you're going to do is, okay, 5 years or 10 years, what's their historical dividend versus what is their dividend right now? Is this a good entry to buy the dividend? And am I getting more yield right now compared to historically? Okay, so it makes sense, but it's also pretty intuitive. It shows that right now you're getting, 33.5% more yield than you would in the 5-year trailing time period. Again, if this is kind of a thing, a valuation metric, using dividend yield as a valuation metric, if it helps you conceptualize or wrap your head around it, definitely go for it. But It's not 100% necessary. I just like to use price to free cash flow on a forward basis. And then, the dividend yield thing. Obviously, if a company's undervalued and it's a good quality company that passes your screens, then you're going to be getting a higher dividend yield than the 5-year average. Okay, moving on. We will go into dividends, guys. The current yield, like we said, is 2.76. I was even able to lock in, let's see, the forward payout is 548. I was able to lock in some shares. Let's see my best fill. 182. I guess I was able to pick up 12 shares at 182. So I was able to lock in, just over a 3% yield on this one with some of my shares, which was exciting. And I do wish I could have gotten more shares over that 3% starting yield level. I'm not really beating myself up over it. I think this is a great opportunity, as well as their 5-year growth rate being 12.52%. Obviously, this is going to be one of the higher, 5-year growth rates we've seen. And that does not by any means guarantee future growth. But if the signs are there, the share buybacks are there, the free cash flow is sustaining their dividend, as well as, they do have that 14-year track record. They do seem pretty bought into rewarding shareholders. I think it's safe to say Hershey's going to continue growing their dividend, and hopefully it is at kind of a more aggressive rate than we've seen on, other companies that are more mature, more down the line. Okay, the trade-off is maybe you're not getting the highest starting yield ever, but that's life, I guess, guys. We will look at the dividend safety, and then we will go ahead and make these share purchases. So again, for dividend safety, all I really use is the cash flow payout ratio, 42.46%. That does say to me, okay, this one is a sustainable dividend. They do have room to grow the dividend at this same cash flow level. And like I said, if they continue issuing share buybacks, that will also help grow the dividend theoretically. I do like to see that even in the past 5 years, guys, okay, even as aggressively as they've grown that dividend, they're still paying out a smaller percentage of their free cash flow than they have been on average in the past 5 years. Okay, does that make sense? So it's kind of one of those things where it's like you've grown your dividend over 12% for 5 years, and you're still paying out less of your free cash flow. It's kind of a great situation from a dividend investor's perspective. And that's what I'm trying to stress today, guys. And we will go ahead and make these share purchases. I'm just going to buy 2 shares today. I'm not really at this point, I'm not really setting an exact amount of money I want to invest all of the time. I'm kind of just doing it, if I can be honest. So, maybe that's not the best philosophy, but I just like to buy stocks. That's kind of how I've always been. I don't like to stress myself out all the time, I need to invest X amount of this. Not really like that, for me personally. So let's go ahead and purchase these 2 shares. That will bring me to a total long position. Right now I have 34. I'm going to buy 2 in this video. That'll take me to 36. I'm currently up just under $500 in terms of unrealized profit. And my average price right now is $184.26. Let's see what I get filled at on these 2 shares. I just got filled at wait, what in the world? I just got filled at 198 and 42 cents or 43 cents. I mean, like I said, I did enjoy buying this one at the 3% yield, but I'm continuing to build out this position pretty aggressively. And I'll continue doing it under 200. We'll see, how long it takes this one to reverse. And if it does crack through that 200 mark soon, I may continue buying it. We'll just have to wait and see how high of a price I'm willing to pay for it. I guess it just depends. Anyway, guys, this is Cashflow Cart. Thank you for joining me in this video. I drop new content every Monday at 6 p.m. And if you're new to the channel, guys, please subscribe. If you're not new to the channel, thank you so much. I see all of you that have commented. Some people comment on like most of the videos. It's awesome. The support's been amazing. Thank you guys so much. Please subscribe or hit that like button. And I'll catch you in the next one, guys. Let's build wealth.